This week revealed something profound about market psychology. While everyone focused on the manufacturing data surprise and the equity rally, the real story was written in gold's 11% collapse and Bitcoin's plunge below 80,000. The crowd celebrated the surface moves and missed the structural shift underneath. This is exploitable because most participants react to outcomes instead of understanding the forces that create them. The human layer tells us everything we need to know about crowd behavior. After Friday's violent deleveraging in precious metals, traders entered Monday desperate for equilibrium. The ISM manufacturing surprise provided exactly what they needed, a permission structure to buy risk assets again. This is textbook anchoring bias. Participants clung to one positive data point while ignoring the structural fragility that Friday's volatility exposed. Look at Disney's reaction. The company beat earnings, yet the stock fell 7% on forward uncertainty. Markets punished ambiguity more harshly than they rewarded certainty. This reveals loss aversion in its purest form. Fear overwhelms logic when positioning is crowded. The precious metals collapse exposed how much of that rally was momentum-driven rather than conviction-based. Gold and silver weren't rising on fundamentals. They were rising because they were rising. Once the first wave of selling began, herding behavior took control. Stop losses cascaded, margin calls forced liquidation, and conviction evaporated. The system layer shows us the mechanical reality behind the emotions. Friday's metals collapse functioned as a forced deleveraging event, clearing speculative excess and resetting positioning across correlated assets. By Tuesday, mean reversion dynamics kicked in. Gold bounced 6%, silver gained 10% as oversold conditions attracted buyers. The equity market's resilience reflected structural bid support. Volatility targeting funds, risk parity allocations, and corporate buyback programs all provided downside cushioning. The manufacturing surprise triggered algorithmic buying in cyclical sectors. Small caps outperformed as economic sensitivity replaced growth momentum. The dollar's surge compressed commodity prices and tightened financial conditions, creating a feedback loop that pressured non-yielding assets. Bitcoin's breakdown below 80,000 confirmed its status as a leveraged equity proxy, not a safe haven. When risk appetite faltered, crypto fell with everything else. The earnings calendar created bifurcated flows. Palantir surged 11%, Teradyne jumped 22% on strong results. Meanwhile, healthcare insurers suffered sector-wide repricing on Medicare policy concerns. This is dispersion at work. Index stability masked extreme stock-specific volatility. The postponed jobs report removed a key data point, but this matters less than most believe. Employment is a lagging indicator. The market has already priced the trajectory. The Fed's path is constrained by political pressure and inflation persistence, regardless of monthly job numbers. The Stoic approach recognizes that volatility is information, not noise. The speed of the precious metals reversal communicated more about market structure than any analyst report could. Crowded trades unwind violently because they must. This is the system functioning as designed, not chaos. The equity rally on Monday was a relief bounce, not a conviction move. Manufacturing data provided a narrative, but narratives are post hoc rationalizations for price action that would have occurred anyway. The system needed to stabilize, so it found a reason to stabilize. The crypto breakdown below 80,000 represents a dislocation, not because Bitcoin is cheap, but because the narrative has shifted and positioning hasn't fully adjusted. The India trade deal offers tactical de-escalation, but tariff policy remains a negotiation tool, and negotiation implies ongoing uncertainty. History shows humans consistently mistake relief for resolution. This week's moves reflect a market transitioning from liquidity-driven to fundamentals-driven behavior. Transitions are inherently unstable. When everyone believes the same thing, the opposite becomes more probable. The system rewards those who think independently and punishes those who follow the crowd. This isn't moral judgment, it's mechanical reality. Anti-fragility comes through diversification of exposure, not concentration of conviction. Second-level thinking means understanding that Friday's collapse and Monday's rally are part of the same process, the market discovering the price of uncertainty. The Stoic exploiter doesn't predict outcomes but prepares for multiple scenarios, recognizing that sustainable edge comes from discipline, not speculation. If you value systematic thinking over emotional reactions, subscribe for frameworks that exploit human predictability rather than chase market noise. The complete system for reading market psychology is linked below, but only if you're committed to discipline over drama.